Well, official interest rates are more likely to fall than rise, according to the Reserve Bank Governor. SBS Finance editor Ricardo Goncalves joins us now. Ricardo, his comments come as the country's biggest bank posted another record profit.
Janice, the Commonwealth Bank updated the market on its quarterly performance, a cash profit of $2.4 billion for the 3 months to the end of September, up 4.3% on the same period last year. Now, it puts it on track to deliver a record full-year result at a time when the banks are lifting interest rates independent of the Reserve. An owner-occupier home loan borrower with a $300,000 mortgage will be slugged with an extra $33 per month in repayments as a result of the bank's recent increase in standard variable rates. But Reserve Bank Governor Glenn Stevens says they can likely afford it.
A significant proportion of owner-occupier households is ahead of schedule on their repayments.
While he's not endorsing the commercial bank's moves, he's not worried about the implications yet.
My preliminary assessment is that the macroeconomic effects of these recent actions in themselves may not be very large.
The mortgage rate rises were in response to the banking regulator's request for the banks to hold more capital. It also prompted the banks to tap the market for cash, eroding their share prices.
That'll be a bit of a drag on earnings per share growth. The other side of it is it'll protect the banks from any downturn if we have one.
But the economy is transitioning.
Conditions have been improving for about 2 years actually, but certainly over the past year. They've been improving, not deteriorating.
A view supported by NAB's quarterly business survey, with conditions rising to a survey high. Business confidence was down, although the survey was taken before the government leadership change.
Well, I think what it's saying is that the economy is doing what we'd hoped it would do, particularly the non-mining sector.
The Reserve Bank does, however, hold some ammunition if growth and conditions temper.
Were a change to monetary policy to be required in the near term, it would almost certainly be an easing, not a tightening.
The opposite is being considered in the United States.
The economy will continue to grow at a pace that's sufficient to generate further improvements in the labour market.
Adding to the case of an imminent interest rate rise.
December would be a live possibility.
Which should add to global confidence and strengthen the US dollar.